Is the widow's tax trap really a trap? Hi, this is financial planner Sean Mullaney. Let's discuss. So people worry about traditional retirement accounts and, maybe it's not so bad while the husband and the wife are alive. But once there's a death, the widow's tax trap is going to get you, right? And I think we have to step back and look at the effects of widowhood on our taxes and on our tax planning. All right. So people like traditional 401k contributions, myself included, because it might be the most valuable tax deduction anyone ever has. It could be that you're deducting your 401k contributions at 24% or even 32% or 35% if you're a particularly high earner. Okay, so that's pretty good. But what about in retirement? Well, while husband and wife are still alive, guess what's going to happen? They're going to go up through those progressive tax brackets, and it might be that almost all of the RMD, the dreaded required minimum distribution, is taxed against the 12% bracket. Could even be, all right, maybe some of it creeps into the 22% bracket. Oh, that's not so great, but you're still winning. Even if you didn't do Roth conversions, and maybe you did do some Roth conversions. I've talked on the channel how there could be an opportunity for some tax-free Roth conversions in one's mid to late 60s. All right, so now we have the first spouse dies, now we have the widow. Well, what happens? What are the negative effects that planning could have in theory addressed, right? Because in theory, what they could have done is they could have just done Roth 401k for all their contributions at work. They have no traditional retirement accounts when they get to retirement, and they never took a deduction, but it'll all be 0% income in retirement. So that's one possibility. But what might happen is, okay, so the widow now has to take some of those RMDs and more, some of the 12% now gets pushed to 22%. Some of the 22% gets pushed to 24%. Well, wait a minute. They took the original deduction at 24%, say. So the widow's tax trap for this particular widow, who's paying 24 cents on the dollar on those last RMDs, well, that's not a trap. That's 24% on the way in, 24% on the way out. And by the way, a lot of the RMDs are still getting maybe the 12% and the 22% bracket. That's no trap, okay? That's, not even an inefficiency. Now, I will introduce a second problem, which is IRMAA. Okay, so IRMAA comes in. It's it's an increase to Medicare premiums, really a reduction in the subsidy on Medicare, different conversation. But essentially, it functions sort of like a tax. It's got a step function instead of percentages. But, from a planning perspective, that could be a 2% or maybe at tops a 3% nuisance tax. And yes, it is, I will say this, widows tend to be subject to IRMAA a whole lot more than married couples. The IRMAA threshold for a married couple is $212,000 in the year 2025. Even affluent married couples have a very tough time showing a lot of that much income. $106,000 is a much lower threshold, and affluent widows can easily show that. So widowhood tends to be the time when IRMAA starts to bite. But, for all the talk about IRMAA, according to the government, about 8% of Medicare recipients are paying IRMAA. So even many affluent retirees don't pay IRMAA. And when you do, it tends to be this sort of nuisance tax. Doesn't have much to do with lived experiences. And, I looked at a situation with my co-author, Cody Garrett, Tax Planning to and Through Early Retirement, where we had an 85-year-old widow. And we said, okay, let's put her in the widow's tax. I'm sorry, it was an 80-year-old widow. 80-year-old widow. Let's put her in the widow's tax trap with a $4 million IRA. Most Americans will never have a $4 million IRA. That generates a RMD of almost $200,000. Most Americans will never sneeze near a $200,000 RMD, but let's go with it. We found that on the RMD, about 16% of it was subject to a 32% statutory rate. Okay, so, a couple that build up a $4 million IRA, we could safely assume they took 401k contributions at 24% during their working careers. In retirement, a bunch of the RMD hits 22%, they're winning, 24% tie, and then 16% of the RMD, not 50%, not 70%, 16% of that very thick RMD is going to be subject to, by our math, and your math could vary, but we use some reasonable assumptions, 16% hits the 32% bracket. Is that a trap? That's an 8 cents on the dollar inefficiency on 1 out of 6 RMD dollars. Okay, not great. IRS won on those 1 out of 6 RMD dollars, but that's an inefficiency. That's not a trap. Really, when we step back, we should call the widow's tax trap the long-lived widow's minor tax inefficiency, not the widow's tax trap. And part of the reason I say long-lived is, well, you could have $100 billion in a traditional IRA. If you die the year after your spouse died, the widow's tax trap has no effect on you. Right? Technically, that last tax return, it will hit, but it has no impact on our financial planning or financial success. So when we step back, we say, all right, the widow's tax trap is real. It increases effective tax rates in retirement when we're a widow, 100% to all that. But is it really this scary trap? No. What it tends to be is, for many people, it just reduces the benefit of those old 401k contributions. Oh, instead of 20, they deduct at 24%. Instead of those last RMDs hitting the 12% bracket, they hit the 22% bracket. Okay, not even an inefficiency. They're still winning against the IRS, and maybe they should have done some Roth conversions. Maybe there was a bit of a missed opportunity there, but it's hardly a trap to, at the end of the day, still defeat the IRS. Or, okay, maybe for the very, very affluent widow, it kicks some RMDs from 24% to 32%. Oh, by the way, that widow could just QCD that problem away. Now, yes, you're giving that money to charity, but maybe they're charitably inclined, right? And so they could take, 6 cents or 1 out of $6, send it directly to charity instead of taking it from the IRA, and all of a sudden, statutory, they're not subject to a statutory rate over 24%, the rate at which they deducted. So I think the widow's tax trap is real, but it's not really that concerning at all. Essentially what it means is, if you're very financially successful using traditional retirement accounts, in widowhood, you may have some relatively modest tax inefficiencies. But let me know what you think about the widow's tax trap, about traditional versus Roth. Let me know in the comments below. Thanks so much for watching this video. If you liked it, please mash that like button and subscribe to my channel. I will see you next time.